Can you hear me all right? I think I'm not on mute anymore. Is that right?
Yes, I can hear you well, Andrew.
Excellent. Thanks very much, Pedro. Hi, everyone. It's Andrew Grant at Carbon Tracker here. I run our research on oil and gas and mining, the supply side of fossil fuels, in other words. I think you've all met or spoken to Mike Coffin, my colleague on supply side, who's also on the line, and Rob as well, who deals with regulatory aspects amongst many other topics. So if we just go on to the next slide, I'll give a little bit of background on Carbon Tracker. I'm sure everyone's familiar with this, but we're just in a nutshell, we're a non-profit think tank established back in 2011, looking at issues around the sort of intersection of climate and finance, but particularly with a climate change lens and what this means for the fossil fuel industry in the context of various demand or climate constrained budgets. So we started off looking at with the simple arithmetic of the carbon bubble, which I'm sure everyone or many people are familiar with, merely pointing out that there's too much carbon available to us beyond that which we're able to burn for a relatively benign carbon outcome. Not a controversial point anymore, I don't think. And from when I joined back in 2014, we then set about putting an economic framework over the top of that to sort of get a market-based view of where future production might come from and where future production might not come from. And that's the sort of approach that we've been taking ever since. So our research remains very focused, very influenced by the economics of the market and the way that we applying simple sort of supply and demand heuristics to try and solve the problem in a kind of a reasonable or representative way. So if we go on to the next slide, I'll just give a little bit of background on our general approach. So we've sort of refined our approach over the years, but core is pretty much the same. So what we do is we try and keep things really as simple as possible. I think we recognise, of course, that the science that applies to our planet is pretty fundamental in some ways, but then when you're trying to do modelling on top of it, taking into account all the sort of socio-economic elements on top of that, clearly when you're trying to model different scenarios, there's all sorts of different scenarios out there, the demand pathways, highly uncertain, so on and so forth. We're kind of aware of all that. We don't try and pretend that we're doing that, that there is more certainty than there is. So we try and account for that in our research by trying to keep it as flexible as possible, as simple as possible, to try and minimize the amount of assumptions that you make that then sort of compound on top of each other. So we really try and just apply a sort of economics 101 approach, really. We take a world of potential supply, we source that from a third-party data source, and then we compare that to various demand scenarios that we also source from third parties, and combine the two and sort of do a bit of modelling. Obviously, I say we try and keep it as simple as possible. Clearly, there's some complexity that can't be avoided. But again, we try and keep that reasonably transparent and easy to explain. And then based on comparing those two data sources in a simple market-based logic, we then see what falls out of that, which then gives you a hypothetical production or emissions or investment pathway going forward, informed by the market's view of the economics of the projects that are available within whichever particular demand constraint you apply. And because, of course, we're looking forward quite a long way out over the next 20 years or so, plenty can happen in that time. Clearly, there's capacity for the market to react to events as they happen. So we tend to think that often the best way of thinking about this analysis is on a relative basis. Just as a bit of background, we're talking about oil and gas here as well. I mean, at Carbon Tracker, we also look at power and utilities, upstream coal, etc. But just thinking about the way we approach oil and gas. So oil, we keep it nice and simple. We assume a single global market applies to the oil market. I think that's a reasonable one to make. That there is sufficient trading to justify that, and the world is relatively joined up in the way that oil is traded. For gas, we take slightly more of a regional approach. So we break down gas into 5 key regional markets, which cover over half of the world, over half of the global gas supply. Those being North America, Europe, global LNG, so not strictly a regional market, but a different market. We've also added Russia and Australia as major gas consumers. Now, clearly, that leaves quite a lot of the rest of the world that's out there. Of course, there are limitations on the amount the ability to use a least cost methodology in markets that don't really have that true supply on supply competition. So in some areas of the world where there isn't really a sort of true market as such, we look at the amount of gas that's available compared to demand. So it has tended to be that on the database, the amount of gas that's available to go ahead in those other markets for gas is kind of comparable to the amount of gas that's required under the demand scenario, even the low demand scenarios. So we tend to assume that all that gas in those other markets go ahead. Were that picture to change, so in other words, were our supply database to sort of add additional gas, which then started to create a very big oversupply of gas compared to low carbon scenarios, we'd need to rethink that. And that's not to say that there is nothing that companies can do in these areas. Clearly, they can do things like improve intensity and kind of limit their exposure to high cost gas options. But for the sake of this sort of high level exercise, we assume that gas in all other markets goes ahead. So let's go on to the next slide. Okay, so I've given a very high level picture of the approach. I'm now going to sort of whistle through what we use for demand, what we use for supply, and quickly how how those interact with each other, and how we present those results. I am going to try, as you probably noticed, I'm probably going to try and get through the presentation quite quickly. Reason being, I want to leave time for questions. So I often think that sort of when I'm going through these presentations, it stirs up questions in people's minds, and it's better to sort of try and tackle those than me try and cover everything in one presentation. So on to demand. Now the topic of demand scenarios has been mentioned, of course, on this call. We have tended to use IEA scenarios. They kind of have the benefits of being reasonably well used. People understand them. They give you a certain amount of information underlying. We've also used the IPCC scenarios, in particular P1 and P2, which are 1.5 degree pathways with various amounts of CCS. We, of course, people sort of love to hate the IEA scenarios for all sorts of different reasons. I think our approach does apply to any different demand scenario that one might want to choose. It's sort of quite flexible in that approach. However, of course, when you are doing modelling, and particularly doing modelling by market for gas, it's sort of the number of scenarios which are available to you, which give that requisite detail, dwindles quite quickly. So the real key advantage of the IEA scenarios is I think that they do give you that underlying analysis that, and then enables you to think about, okay, I know what the demand for gas is going to be in the LNG market, or North America, or Russia, or wherever you might happen to be, which is unfortunately marked out as quite a small group of scenarios. Of course, the IEA give you their scenarios on one basis. You're then complying them to data on a slightly different basis. So there's a certain amount of interpretation that has to be done when you're starting off with the IEA scenarios. For example, as you know, there's not a standard definition of a barrel of oil equivalent. The IEA's definition and the definition used by supply database providers might vary. So you have to do a little bit of conversion there. Other little changes. So, for example, we use linear interpolation between the data points that the IEA gives you, typically every 5 years. We also, given that the IEA's most recent data point is usually a couple of years in the past, tend to bring in whatever recent history has happened based on more recent publications. And again, typically IEA wants to try and keep it as consistent as possible. But it's about I think the point to make is that really that there's clearly quite a great degree of flexibility from picking your demand scenarios that are available. But even once you've picked a demand scenario, there's often a little bit of additional work that has to be done in terms of making it as accurate and representative and applicable to the present day and the supply data as possible. So let's move on again to the next slide. Okay, so I mentioned that we have used third-party data for demand scenarios. We also use third-party data for supply. Now there are pragmatic reasons for that. Clearly, the world of potential oil and gas production is pretty big, and with only a small research team at Carbon Tracker, we certainly wouldn't want to try and model all the individual projects around the world. But we think there are other advantages as well. So, for example, if you have a third-party data provider, that then gives you an internally consistent view of the world of potential supply out there. They apply the same methodologies all throughout their universe of production. There's clearly a degree of impartiality. No one can say, "Oh, Carbon Tracker have got an axe to grind. They're setting these costs to particularly hurt my particular company." We don't change the costs at all. We draw them from the third party. I also think, and this, I suppose, this particularly compares to the scenario analysis that sometimes companies do and present in the public realm. I think there's greater transparency. So if a particular oil company did a scenario analysis, said the results are X, Y, and Z, we're fine. There's no recourse. You can't sort of check up on that, no matter how interested you are. Whereas if you wanted to understand the cost or the assumptions going into the data that we use, admittedly there's a cost for it, so it's not like it's totally available, much that we'd like that to be the case. But anyone who does subscribe to that data can then dig into it and replicate the analysis themselves, or understand a little bit further in terms of the information that's used. And also, I suppose, to the advantage of companies, I mean, one of the issues that gets brought up a lot is that companies are sensitive to disclosing their own estimates of their project costs. Happens on occasion, doesn't happen routinely that these projects are disclosed, hence why we have to use a third-party data provider. By using a third-party data provider, that then sort of avoids the issue for companies to have to disclose their own estimates if it's something that they are uncomfortable doing. Of course, there are arguments why companies should give better disclosure on their own project costs, but that's kind of a separate question. So I think that's tackling the third-party data provider question in kind of more generic terms. So in order to drilling down a bit further at Carbon Tracker, we tend to use data provided by Rystad Energy, who are a Norwegian oil and gas data provider. We've also used Wood Mackenzie data in the past. Other data providers, of course, available. I think there are clearly a number of factors that go into considering which is the best data provider for you. Again, you've got the kind of the practical questions of, okay, how much is this going to cost me for the data? How difficult is it going to be for it to resource? But also there's other questions as well that you can ask around things like, how do you see the quality of data? How comprehensive is the data? If an oil and gas industry database provider only covers, let's say, 80 or 90% of production, because that's what their clients are most interested in, and then they don't worry about the long tail, that potentially gives you a bit of an issue when you're trying to compare supply to demand, and might lead to you over or underestimating the potential risks from other supply sources that are available. So let's move on to the next slide. Okay, so I've covered briefly where we start off with supply, where we have demand, where we start off with demand. The next step is to compare those two together, and I'm sorry that the text on this slide has gone very small. So essentially what we do is we assume that post-FID projects, in other words, those that have taken a final investment decision, either projects which are already producing, or those assets which have been greenlit but are under construction, but not yet in full production, we consider those projects as sort of effectively locked in. We assume that those projects will continue to produce for their base case lives. We think that's a reasonable assumption. I think we think that reflects the reality that the capex on those projects is effectively sunk, and now they only have to cover their operational economics on a day-to-day basis. I think barring particular particular circumstances, maybe we're in one at the moment, it's sort of quite rare to see projects which have already been sanctioned get shut in, and so that tends to be quite a short-term effect. So I think when you're looking at over 20 years or so, I think that's probably a reasonable one to take. So having kind of assumed that post FID production, once it's been sanctioned, it's there, it's then producing. That means if you're comparing potential supply to potential production, to potential demand rather, already quite a lot of your potential demand is then accounted for by projects which are producing. As you all know, oil and gas production tends to decline at a sort of rate that depends on all sorts of different factors. So there is typically still space for new production, even with additional even with current production locked in. So any shortfalls between base supply and production and demand under a particular scenario, we then fill in with what the potential available universe of supply options available to us. We then compare those projects to each other on the basis of cost, and we model the amount of gas and oil that goes ahead on a project by project basis, which again, as I say, we try and keep as simple as possible, but there are certain complexities. And I think, and one of those that's probably worth highlighting is that there is a certain amount of circularity when you're thinking about how you settle the market. So, of course, many oil projects, when developed, will produce gas associated alongside. That gas then can go and be marketed. It may not be marketed, it might be flared, but for where that gas is marketed, that then goes into satisfying demand for gas. And the same is true the other way around. So a lot of gas projects have a lot of associated liquids that then feeds into demand for oil and other liquids. So there's that kind of that interdependency between the different markets, which means that we have a model that kind of solves on an iterative basis. So it basically, if you run your oil supply and the associated gas with that, means that there's an oversupply in gas, and your gas supply means that there's an oversupply in oil because the associated liquids. We then iterate the market until that oversupply is cleared as best as possible. So therefore, it gives us sort of internally consistent approach whereby you're not looking at oil and gas separately. If a project goes ahead, we know that its oil has a market and its gas has a market. So it's not just a case of the cheapest oil production goes ahead and we ignore the gas, or the cheapest gas goes ahead and we ignore the associated oil. So I mentioned that the way we tend to determine which projects fit in a limited amount of demand left in a low carbon world is done based on cost of supply. We take the sort of classic device of a cost curve to illustrate this, where you just line up all projects in cost order, and I'll come on to an example of this in the next page. But we think this has some real advantages. So firstly, we think it probably reflects best the way the world is as we see it, the sort of market-based world that we operate in, given the nature of oil, gas, and other commodity markets. Typically, that it's characterized by competition on production costs. It tends to be that if you are a high-cost producer, you tend to find it difficult to compete with projects that are low cost when it comes to satisfying a given level of demand. Again, we think that kind of is reflective of the way the world pans out. It also means you end up with differentiated kind of pathways for different producers that again reflects the way that the market has reacted in previous history, and indeed you could say is reacting now. So, for example, with Saudi Aramco having some of the lowest production costs in industry, we tend to find that even in a demand constraint, their production tends to sort of continue at a fairly steady level, incorporating the assumptions of the database we use. However, for higher cost or more marginal producers in more threatened end of the cost curve, you may find that their production falls off more quickly in a low carbon scenario because they're less competitive. We are going to be seeing a dry run of this over the next year or so, one imagines, given what's going on in the markets. So we think that a supply cost approach is the most reflective of our economic reality that we have, but also it has other advantages. So, for example, reasonably simple, people get it. Whenever oil and gas companies approach us and ask how we where we start off with our assumptions, we know that we're starting off on common ground because typically this is the way everyone in industry uses it as well. So we find that really it's kind of helpful when trying to sort of develop people's understanding or have a conversation about these things. At least everyone's kind of starting off from the same place with a common understanding of the market. One further point I think that I should probably make clear is that we don't make any assumptions in terms of future carbon prices when it comes to costs. Now, I noted that the costs we use are directly from the database providers that we use. We don't amend those costs in any way. I think one way that companies who do their own scenario analysis operate is by assuming a certain carbon price. So they might say, we assume a forward-looking carbon price of $40 per ton of carbon, let's say, which then translates into a $1 or $2 a barrel carbon price on average. Firstly, it really that comes down to our logic of trying to assume carbon price, of trying to minimize assumptions. We don't really want to make assumptions about what carbon price might look like in Indonesia in 2040. So we think it's probably most resilient and replicable way to do it, to not make that assumption, but also because we think that generally speaking, much of that is going to be a second order effect in terms of cost. So, as I mentioned, for the average project, clearly this varies, but for the average project, the average oil project, a $40 ton carbon price translates into $1 or $2 a barrel, which in the context of production costs and indeed oil price volatility is probably sort of somewhere within the margin of error. So we just focus purely on the supply costs as modeled by a database provider. So let's go on to the next slide. Okay, well, this one. So it was the previous one. Yeah, unfortunately, it's been a bit of a. That one hasn't panned out very well, unfortunately. So you can see so there's an illustrative picture of a cost curve, which is unfortunately got a formatting challenge with some of the bullets behind it. So the measure of cost that we use is the point forward break even, and when I say point forward, I mean it only looks at forward-looking cash flows. We don't look at cash flows that are in the past. Again, this is really reflecting the issue around kind of once capex has been sunk and it's in the rear view mirror. Costs are really sort of what drives whether project costs operate or not is done purely based on their future cash flows. That's sort of a key tenet of corporate finance. Another point I was supposed to make around this is when I say a break even, I don't necessarily really mean a true break even. Yeah, sorry, I see the comment. Not to worry. So we use break even as shorthand, but at the same time, what we're including as a discount rate is 15% IRR. So what I mean by break even, or how break even is typically defined for the purposes of this sort of analysis, essentially the oil or gas price, which gives an NPV of 0 for discounted future cash flows, based on whichever discount rate you happen to have used. If you were looking at a true break-even cost, you'd be looking at something like the company's weighted average cost of capital as that discount rate. For a major, maybe that's something of the order of 7-8%, that's something like that. So that's the cost there, whereby the company can raise capital at that rate. If it was delivering that return on its assets, it would be a true break-even. In other words, the company would be neutral as to whether it did it or not. Delivering a return below that would mean it destroyed value. Delivering a return above that means that it has created value. What we assume here is a 15% discount rate. So in other words, if a project had a break-even under our analysis of $40 and it then achieved $40 throughout its life, it would generate a 15% return, which clearly is more than enough to cover pure capital costs. We use this as really a minimum that a company would require for sanction, or at least a proxy for that. So really what we're including here is not just covering cost of capital, but also including a bit of a contingency for cost overruns and delays, which of course are not unusual, and also a minimum return for shareholders as well. But really, we use 15%. You could also use, let's say, 10%. The key thing really here is it's not the absolute level of cost that is assumed. It's where projects are ranked relative to each other on that supply curve. So the supply curve, you can see, I'm sorry, and that's that quite small chart, is the red curve is the world of potential supply options of oil, lined up in cost order, lowest cost projects down to the bottom left, highest cost projects up to the bottom right. You then draw a demand line on it and see which projects fit within that based on their supply costs. In other words, projects to the left tend to go ahead in any scenario. The projects further to the right tend to only go ahead in scenarios where you assume a higher level of demand. So what you can see from that instantly is that it's not what's not important is whether the cost of a project is necessarily 50 or 55, or in particular, it's where it is relative to its peers. It's okay, a project's cost might be 50, but are its peers at 45 or are they at 55? It's really about competitiveness rather than the rather than the precise level of costs. And this builds in a certain amount of future proofing, and again comes down to minimizing assumptions a little bit. So if we'd done this analysis back 10 years ago or so, back in, let's say, 2011, 12, 13, when costs were much higher than they are now, you'd be finding a much higher supply curve than we have at the moment. So you might be thinking, okay, well, my project has a $70 oil cost, $70 break-even cost, therefore I'm absolutely fine. That turned out not to be the case, of course, because when the oil price fell back in 2014 over to 2016, the supply curve moved down as well. So we look at the fundamentals of where projects stand relative to each other. Projects can move in terms of cost relative to each other as market dynamics change, but that's sort of less an effect than oil price volatility. It can, I think, it probably reflects the fact that you probably even this analysis will need to be repeated over time. So we do it approximately annually. I think we've also, another key point I suppose to mention is that what we're doing here is assuming market rationality over time. So we say, okay, in a low carbon world, these are the projects that shouldn't go ahead. That's not to say that they won't go ahead. So we try and be conservative. We exclude projects which are particularly high cost and don't go ahead even in a business as usual scenario. I think I'll come on to this more on the next slide. However, some of those projects still do go ahead. As practice shows us. So I think it's clear that compared to a 1.7 or a 1.6 or 1.8 degree scenario, projects are being sanctioned at the present day, which wouldn't fit into our analysis if we would say, okay, what's the economically rational way of getting there? As I say, once a project is sanctioned, we then assume it's pretty much locked in. So what happens effectively is that those projects then go into the supply stack. They take up space from future production, potentially, which might be at a lower cost. So the fact that those projects which are being sanctioned at the moment are producing and will continue to be so, of course, doesn't mean that they will deliver value in the long run. So it's not a free pass. It's not encouraging people to sort of rush for the exit and sanction all their projects as quickly as possible, because that just may mean that you end up stranding all your investment. So let's go on to the next slide. I don't think I've got many left. Okay. I thought one point I thought I'd covered, maybe I covered it early in the slide and skipped through it. It's about the fact that we ignore projects which are particularly high cost. So actually, sorry, Pedro, if we wouldn't mind just going back to the previous slide with that illustrative cost curve, you'll notice I've grayed out the top right hand, while the right hand extent of the cost curve. The reason for this being that back when we first did this analysis at the company level in 2017, we said we looked at the entire extent of the supply curve. And we said, okay, well, these are these projects that are available to us. The proportion of these that wouldn't go ahead in a low carbon scenario is X%, whatever it was at the time. Companies and investors, not unreasonably, came back to us and said, well, some of these projects aren't on the table at the moment. They may have been a few years ago, but with the oil price volatility fresh in the mind, they weren't sort of realistic projects for sanction in the next couple of years. And we thought, okay, well, that's fair enough. So for conservatism, we sort of applied a rule to try and do this in a fairly consistent and straightforward manner, whereby we said anything that doesn't go ahead in our modelling in the IEA central scenario, their new policy scenario, it's about 2.7 degrees of warming, incorporates the Paris NDCs. Anything that doesn't go ahead in that scenario, we just exclude it entirely from our modelling. We don't count it against companies at all. As I say, that means we're being fairly conservative. It does also mean that when we look at our results, it means we miss or exclude some opportunities to destroy value that are plausible. And again, experience shows us that some assets have been sanctioned that are above even that business as usual level of demand. We're not capturing all opportunities to destroy value here, but we are doing something whereby it really gives a sort of consistent and conservative base to analysis. Companies, the industry, or whoever comes out badly out of the analysis can't say, well, those projects are totally unrealistic, they'd never be done, because if we're going to get to a 2.7 or a 3 degree world, which is kind of, well, as I say, it's the IEA central scenario. It's also not a million miles away from the scenarios produced by people like Wood Mackenzie or ExxonMobil or other companies that have their own demand analyses. If the world is expected to get, or if a base case scenario is for the world to get to that sort of level of warming, those are the projects that must be expected to be reasonable or to go ahead in order to satisfy that level of demand. So let's go forward again now to the next slide. So, to the one before, yeah, thanks. So, as I mentioned, we do the analysis at the project level. We line projects up in terms of their costs. We sort them out into whether they fit inside a demand constraint or whether they fall outside it. And then how you choose to present that analysis is then up to debate. So you can do it at different levels. You can either roll it up to the region or the company, because of course this is done at the project level. So you can roll this up to any higher level that you prefer just by adding together those projects and by seeing a company as the aggregate of all the projects that it has. You can also present the data in different ways. So you can think about it in terms of the carbon associated with that production. You can think of it as the production in terms of barrels of oil or BCM of gas. You can think about it in terms of capex, in other words, the dollars of capital investment associated with each of those projects. Now, we're actually at Carbon Tracker, we've used all three of those. We often tend to portray things in terms of capex. There are a number of reasons we like it. I mean, firstly, it's kind of a financial metric that illustrates that there is financial risk associated with developing projects that might be stranded. It's clearly not a clear read across to value because it doesn't include things like the revenues that come from that capex or the time value of money. But it does illustrate that opportunity that there is to destroy value, or alternatively, if companies aren't going to destroy value, then the extent to which they're going to have to change their business model going forward. I think another reason we like capex is that it doesn't paint the scenario as, oh well, the industry is doomed. They're just going to be value loss all around. It shows that companies have an ability to change, and of course, companies do have flexibility with their capex. They can choose to invest it, or they can choose not to invest it. So I think really it gives it. That means this information is useful for a number of different audiences, but particularly people like shareholders who have engagement in mind. Another advantage of capex compared to things like NPV as a metric is that it's not quite so fundamentally reliant on the oil price. So, I mean, capex intensity of projects is related to oil in a low oil price, or even commodity prices. In a low commodity price world, for service providers can well, end up having to charge lower rates. Companies are more, they trim the fat from their budgets in various different ways. So it's not like they're totally irrelevant to each other, but it's not a core concept that goes into it, like MPV, where you're totally reliant on having an oil price assumption. Whereas, as we all know, predicting the oil price is a very difficult thing to do at the best of times, even if you have a clear insight of potential demand and potential supply over the future. Now, I have mentioned briefly that our exclusion of the MPS projects that fall outside the new policies project scenario, or as it's now known, the stated energy policy scenario. We also, that reflects how we present our results. So for CapEx, we tend to reflect results relative to, again, that's that new policies or that steps level of demand or CapEx that goes ahead. So that's particularly talking about it in CapEx. Relevant to this discussion, though, is the amount of production or carbon associated with that production that goes ahead, which is something that we've also modelled. We haven't done it as regularly, but we did it last year, for example, in a project which Mike Coffin on the line was the key author of, called Balancing the Budget. So in that analysis, we basically did the least cost methodology in terms of which projects go ahead in a low carbon world, which companies hold them, and then looked at the amount of production going ahead from those projects and the amount of carbon associated with those projects using asset level estimates of carbon. Again, we sourced those from Rystad Energy, but clearly there are other ways around that. So, for example, one could just apply more simple emissions factors, or companies may indeed have more detailed emissions factors for their project. And then we use that to do a sort of point forward estimate of the amount of total carbon that companies would have being produced from their assets based on a sort of economically rational least cost pathway, but crucially that which is bounded by a demand constraint, and also whereby, again, as Paul mentioned, really with their work, it's compliant with a particular budget. So if you roll up, because our modelling starts off at the industry level, and then is converted down to the project to project level estimates of carbon, and then rolled back up again. Everything adds up at the high level. So the amount of production that goes ahead in our company level analysis of future carbon emissions all adds up to a global carbon budget that ends up being consistent with those, with whichever scenario you end up using, whether it's IA or something else. So I've actually talked for much longer than I hoped for there, so apologies for that. But I'll wrap up there, and we can go on to any questions if people have them.